Throughout history, the most important financial mistakes people make don't come from what they don't know. They come from what they know for sure. That just isn't true. Right now, millions believe the money in their bank accounts is safe, that paper currencies will always buy what they need, and that the system will continue as it has. But if you step back and look at the long arc of history, the opposite is true. Every currency is devalued. Every empire overextends itself, and every time gold and silver quietly wait to play their role as the ultimate measuring stick of value. So the question isn't if you should own gold and silver, it's how much you should own before the price runs away from you. Because what most people don't see is that we are at a point in the cycle where time is running short. What most people miss when they think about money, wealth, and security is that none of these things are permanent. They exist inside cycles, and those cycles repeat themselves more often than we'd like to believe. If you look back through history, whether it's the rise and fall of the Roman denarius, the collapse of paper currencies during periods of hyperinflation, or the quiet erosion of purchasing power in modern fiat systems, you see the same pattern. At the beginning, confidence is strong. That is where we are today. The currencies people treat as stable are not truly stable. They are simply in the middle of their life cycle, and like every cycle before, they will move from credibility to fragility, from being sought after to being avoided. Once you see the process for what it is, it becomes less about opinion and more about inevitability. The problem is that most people experience this shift too late. They anchor themselves in what worked during the prior part of the cycle, assuming it will continue indefinitely. In the early stages of currency debasement, the signs are subtle. A little more inflation than expected, a little less purchasing power, a quiet rise in the price of gold and silver, or the central banks of the world buying quietly in the background. By the time the fragility becomes visible to everyone, the repricing of real money is already well underway. It's important to remember that this cycle is not just about economics. It's also psychological. Wealth is built and destroyed not only by the numbers on balance sheets, but also by the shifts in confidence. When people stop believing a currency will buy tomorrow what it buys today, they move their trust somewhere else. That movement of trust from paper to hard assets is what drives the violent repricing. You don't need hyper-inflation for that shift to occur. You only need the collective recognition that paper money is not a reliable store of value. We are living in a period where debts are higher than incomes in most major economies. Interest rates are caught between the need to control inflation and the inability to handle higher payments, and governments everywhere face obligations they cannot realistically meet. That is fragility, and fragility doesn't announce itself politely. It snaps when least expected. The cycles of wealth are tied directly to this. When money loses credibility, wealth measured in that money is redefined. Those who held paper see their claims diluted, while those who held real assets see their purchasing power preserved. That's why across centuries and across civilizations, gold and silver reappear as the foundation when everything else breaks down. They are not investments in the speculative sense. They are insurance against the cycle itself. The crucial point to understand is that fragility isn't an accident. It's the inevitable outcome of the way the system is designed. Once the machine of debt, money printing, and political promises is set in motion, it always ends the same way, with a transfer of wealth from those who trusted the paper to those who prepared for its decline. So when we talk about cycles of wealth and currency fragility, it's not a question of if, it's a question of where we are in the timeline. Right now the signs are clear. We are late in the cycle where the debts are unpayable, where the printing has become normalized, and where the credibility of money is quietly eroding. And just like every time before, those who recognize it early will protect themselves, while those who dismiss it will pay the cost. That is the rhythm of history, and ignoring it doesn't stop the cycle. It only ensures you become a victim of it. When you look at the story of money over thousands of years, you realize that what feels permanent in one era is usually temporary in the bigger picture. People often assume that the system they grew up with will continue indefinitely, But history shows that every currency, every empire, and every financial order eventually shifts. The precedent is there written over and over again from ancient civilizations to modern economies. The details differ, but the underlying pattern is the same. Trust is built, wealth accumulates, debts rise, and then the foundation of money is shaken until it collapses or resets. Consider the Roman Empire. For centuries, their silver denarius was trusted across continents. It wasn't just money, it was credibility, stability, and power. But over time, Rome expanded beyond what it could afford, funding wars, building projects, and a vast bureaucracy. To manage the growing burden, leaders debased the currency, reducing the silver content in each coin. The people noticed. Prices rose, confidence eroded, and what was once the world's most stable currency became nearly worthless. The fall of the Roman currency wasn't a coincidence. It was the natural result of debt exceeding income and the temptation to print or debase becoming irresistible. Fast forward to the Weimar Republic in the 1920s. After World War I, Germany carried debts so large they could never realistically be repaid. The government's answer was to print more paper marks. At first, it seemed like a solution. Wages could be paid, debts could be serviced, but then the precedent repeated itself. Confidence evaporated. What started as gradual inflation turned into hyperinflation. Ordinary people saw their life savings vanish in months. A wheelbarrow of paper money couldn't buy a loaf of bread. Those who had hard assets, gold, silver, land, kept their wealth. Those who trusted the paper system lost everything. This isn't confined to distant history. In the 1970s, the United States faced a similar test. After decades of running deficits, the promise that the dollar could be exchanged for gold at a fixed rate was no longer credible. Foreign governments led by France began demanding gold for their dollars. Rather than lose all its reserves, the U.S. ended convertibility in 1971. Overnight, the world shifted to a purely fiat system, money backed not by gold, but by confidence in governments. What happened next? Inflation surged, gold and silver prices exploded, and once again, the cycle repeated itself. Those holding paper lost purchasing power. Those holding real money preserved it. The precedent continues today in less developed economies. Look at Argentina, where decades of currency crisis and debt defaults have created a culture of distrust in paper money. Families instinctively protect themselves by holding dollars, gold, or silver because they've learned the lesson that paper promises can't be relied upon. Or look at Venezuela, where hyperinflation destroyed the bolivar and forced people into barter and hard assets for survival. These aren't anomalies. They're reflections of the same recurring pattern we've seen across time. The lesson in all these examples is clear. Currencies are not permanent, and every system reaches a point where trust is broken. The specifics of each case, wars, deficits, political mismanagement may differ, but the outcome is always the same. The form of money that is easily printed or manipulated eventually fails. The form of money that is scarce and trusted, gold and silver, remains. What's striking is how few people study these precedents. The majority assume that because they've only known one system in their lifetime, it will last forever, but history doesn't support that assumption. If you were living in Rome and Weimar Germany in 1970s America, or in modern-day Argentina, you would have felt the same false sense of permanence right before the shift occurred, and in every case, the shift came faster than expected, and the revaluation of real assets was dramatic. This isn't about nostalgia for a gold standard or fear, mongering about collapse. It's about recognizing the long-term mechanics of how money works, debt builds, governments reach for the easy solution. Paper weakens, confidence breaks, and when it does, gold and silver don't just rise in price. They reassert themselves as the measuring stick of value. That's the historical precedent. The danger is in ignoring it. Because those who say this time is different are usually the ones most exposed when the cycle proves otherwise. Those who study the past, who understand the rhythm of monetary history, recognize that the present moment is not unique. It's another chapter in the same recurring story. and history has never been kind to those who waited until after the shift to act. If you step back and look at the world as it is right now, you see a set of conditions that line up with latest stage cycles. Debt has reached levels that can never realistically be repaid in sound money. Governments, corporations, and households are all carrying burdens that depend on cheap credit to survive. Central banks face an impossible dilemma. If they raise interest rates high enough to fight inflation, they break the system under the weight of debt. If they keep rates low, inflation accelerates and erodes the value of money. It's not a choice between good options. It's a choice between different forms of pain. The current environment is shaped by decades of policies that traded short-term relief for long-term fragility. Whenever growth slowed or markets stumbled, the answer was more debt, more liquidity, more intervention. Each time it postponed the reckoning, but it also made the underlying imbalances worse. Now we've reached the stage where printing and borrowing no longer create sustainable prosperity. Instead, they create distortions, bubbles, and inequality that make the system more unstable. Inflation is one of the clearest signals of this fragility. For years, people assumed that inflation was dead, that central banks had mastered the art of keeping prices stable. That illusion broke when governments unleashed unprecedented amounts of money creation during recent crises. The cost of living surged, wages lagged behind, and ordinary savers discovered that their dollars, euros, or yen bought far less than before. This isn't just about higher prices, it's about the erosion of trust in the currency itself. Meanwhile, central banks themselves are sending a powerful message through their actions. They are buying gold at the fastest pace in decades. Nations outside the traditional Western system are looking for alternatives to the dollar and global trade. These aren't small signals. They are evidence that even the managers of the monetary system see its limits. They are preparing for the possibility of a world where paper promises no longer carry the same weight. At the same time, geopolitical tensions are rising. Trade wars, sanctions, and shifts in alliances are reshaping how nations think about money and reserves. In this environment, holding assets that are neutral, scarce, and not tied to any single government becomes more valuable. That is why gold demand has surged and silver, though less visible, stands at the intersection of monetary demand and industrial necessity with growing use in energy, technology, and medicine. Its supply, unlike paper currency, cannot be conjured up with a keystroke for the individual saver. This environment is deeply challenging. The old playbook of simply holding cash and bonds no longer works the way it did. In the past, bonds, which once provided both income and safety, now carry the risk of being devalued by inflation. Cash, which feels secure, quietly loses purchasing power every day. Stocks, which thrive on growth and stability, are vulnerable to the pressures of rising costs and slowing economies. In other words, the traditional portfolio is exposed on all sides. This is what late cycle environments look like. It's not about predicting the exact date of a collapse or a reset. It's about recognizing the conditions when debt is excessive, when money creation is normalized, when inflation is persistent, and when geopolitical risks are high. The margin for error disappears. What once seemed like a stable, predictable system becomes fragile and prone to sudden shocks. The danger is that most people continue to behave as though nothing has changed. They trust that central banks can always fix the problem, that governments can always fund their obligations, and that the currency they use every day will always hold its value. But history shows that when the environment reaches this stage, adjustments come quickly and often brutally. The very things people believed were safe turn out to be the most at risk. The current environment, then, is not one of stability, but of transition. It is the bridge between the end of one cycle and the beginning of another, and transitions are always messy. They test assumptions, break illusions, and redistribute wealth in ways that seem unfair to those who weren't prepared. The lesson is not to predict every move or every price, but to position yourself so that no matter which form the adjustment takes, whether inflation, currency debasement, or debt crisis, you maintain stability. That's why this moment is so important, because once the shift becomes obvious to the majority, the opportunity to act quietly will be gone. The environment we are in is late stage, fragile, and unsustainable. And the people who see it clearly today will be the ones best prepared for tomorrow. What people often underestimate is how quickly conditions change once confidence begins to shift. At first, the signs are subtle. Small moves in prices, central banks adjusting their positions quietly, investors whispering about hedges. It doesn't feel urgent, but history shows that the window to prepare is always shorter than expected. By the time the crowd realizes what is happening, the repricing of real assets like gold and silver is already well underway. That is why the concept of waiting for the perfect time is an illusion. The perfect time is before everyone else sees it. Because once the crowd moves, the opportunity is gone. The closing window we face now is a product of both structural and psychological forces. Structurally, the debts are already too large, the obligations already too heavy, and the monetary system already stretched. Politicians and central bankers don't have the option to pull back. They are locked into a path of more stimulus, more money creation, and more attempts to postpone the pain. Psychologically, the public is beginning to sense that something is wrong. Inflation that was called temporary persists. Savings don't go as far. The cost of living keeps climbing. Confidence is slowly eroding, and once it crosses a tipping point, the move into hard assets accelerates. You can see this in the way institutions are behaving. Central banks are buying gold at record levels. Major investors are quietly increasing allocations to precious metals. Nations are seeking alternatives to the dollar and trade. These are not accidents. They are signs that those closest to the system know its vulnerabilities, and they are not waiting for the headlines to make it obvious. They are acting before the window closes for the individual. The challenge is recognizing that the current prices of gold and silver represent a rare moment. They are still accessible to the ordinary saver. They are still undervalued relative to the size of global debt and money creation. But that won't last forever. When the revaluation comes, it won't be gradual. It will be a step function, sharp, sudden, and irreversible for those who hesitate it. The danger of waiting is rooted in human behavior. People anchor themselves in the present. They believe that because they can still buy an ounce of gold or a handful of silver coins today, they'll be able to do it tomorrow, next month, or next year. This isn't speculation, and it's the rhythm of history. In every previous cycle of monetary stress, there comes a moment where those who prepared early were rewarded, and those who waited were punished. The lesson isn't about timing the top or bottom perfectly. It's about positioning yourself before the herd realizes what's happening. Wealth in these moments doesn't transfer slowly. It transfers in sudden, dramatic bursts. Think of the 1970s. At the start of the decade, gold was $35 an ounce. Most people dismissed it. By the end of the decade, after inflation and monetary instability had run their course, gold was over $800 an ounce. The people who bought early had preserved and multiplied their wealth. The people who waited until it was obvious were effectively priced out. The same dynamic is in play today. The scale is larger, the debts are bigger. The printing is more aggressive, but the underlying mechanics haven't changed. So, the real risk now is not in owning gold and silver. It's in not owning enough while the opportunity is still open. The insurance is cheap compared to what it will cost when confidence breaks. The trade is asymmetric, limited downside for holding now, unlimited downside for waiting. That's why this moment is so critical. The window is not a permanent opening. It narrows a little more each time central banks print. Each time inflation erodes purchasing power, each time a geopolitical crisis shakes trust in paper assets, and one day it closes, at that point the only people left with access are those who acted early. Everyone else will watch the price climb out of reach, wondering why they waited for confirmation that never came in time. This is not about fear, it's about clarity. The cycle is repeating, the signals are visible. The window is closing, and the choice is whether to step through it now or watch it shut from the outside. When it comes to protecting wealth in uncertain times, the hardest part isn't understanding what's happening. It's deciding what to do about it. People often overcomplicate the process, looking for exact numbers or perfect formulas, but the truth is simpler. The point of holding gold and silver isn't to predict short-term price moves or to trade like a speculator. The point is to build a foundation of resilience, a safety net that preserves purchasing power when the financial system becomes unstable. Practical guidance begins with mindset. You're not buying these metals to get rich quick. You're holding them to avoid being poor when paper currencies lose credibility. That means shifting the way you think about them. They are not stocks, they are not bonds, they are money in its most basic and enduring form. And the decision of how much to hold comes down to one principle. How much of your wealth do you want protected from the risks of paper assets? A useful approach is to think in terms of percentages rather than absolute amounts. For some, 5 to 10% of their net worth in precious metals may feel sufficient as insurance. For others, especially those who see higher risk in the current environment, 20% or more may feel appropriate. There is no universal answer because circumstances differ. Your income, your obligations, your tolerance for volatility, and your broader portfolio all matter. The key is that you hold enough so that if currencies weaken substantially, you're not left exposed. Another piece of practical guidance is diversification within the metals themselves. Gold and silver play complementary roles. Gold is the anchor. It's recognized by central banks, institutions, and investors worldwide as a store of value. It provides stability and is easier to store large sums in a small space. Silver, on the other hand, has more volatility, but also more upside potential. It's both money and an industrial metal, meaning its demand comes from two directions at once. Historically, silver has outperformed gold during periods of monetary stress because of this dual demand. Balancing the two creates a more resilient position than relying on one alone. Consistency is another principle. You don't need to buy everything at once. In fact, spreading your purchases over time can help smooth out volatility. A disciplined approach, accumulating steadily month after month, removes the temptation to try and time the market. Timing usually fails because repricings happen suddenly. What protects you is not catching the exact bottom, but ensuring that when the shift occurs, you already own enough. It's also important to prepare mentally for volatility. Precious metals don't move in straight lines. They can sit quietly for years, then surge in a matter of months. If you go into it expecting smooth performance, you'll be tempted to sell at the wrong times. The right mindset is to view them as a core insurance position, something you hold regardless of short-term swings because their purpose is long-term preservation, not short-term gains. Liquidity is another consideration. Gold is highly liquid globally, accepted everywhere. Silver is also liquid, but bulkier, so it takes more space to store significant value. Understanding these trade-offs helps you decide how to allocate. Think of gold as concentrated insurance and silver as leveraged insurance, with both serving critical but slightly different purposes. Finally, the most practical guidance is to start. Too many people get stuck in analysis waiting for the perfect entry point or the perfect amount. But perfection is the enemy of action. What matters is that you have something, that you've taken steps to secure a foundation outside the fragility of paper money. Once you begin, you can adjust, rebalance, and refine. But you cannot retroactively buy at today's prices once the revaluation occurs. The path is straightforward. Hold enough to sleep well at night, diversify between gold and silver, keep a portion in your own possession. Add consistently over time and commit to the long-term purpose rather than chasing short-term moves. That is practical guidance in an environment where the risks are clear and the window to act is closing. Because at the end of the day, the cost of being slightly early is small compared to the cost of being too late. In the end, the choice is simple. You can wait until the crowd recognizes the truth when gold and silver are multiples higher and every headline screams their importance. Or you can act now quietly, deliberately while they remain accessible. The opportunity is not infinite, the window is closing, and as history teaches, those who prepare before the storm not only survive it, they come out stronger on the other side. That's the cycle we are in.